how much you're making from each client in the first year that you do business with them is going to always limit your ability to invest in business growth, in business development. Or even better, look at 90-day value. And so if you are able to spend $1 and have it bring back more than $1 in the first 90 days, well, suddenly the same marketing budget can be rolled over 4 times. And so every 90 days, you're spending the same dollar on marketing. And so your marketing budget looks a lot bigger, but you're not really adding more to it, in the same way that you would have to if you're trying to spend that same amount, but you're not making back that in revenue until year 2. Welcome to Daily Discovery Calls for Financial Advisors, the first and only show dedicated exclusively to helping entrepreneurial, growth-driven financial advisors book more discovery calls with qualified prospects every day of the week. I'm your host, Roy Furr, the Advisor CMO. Let's get into it. All right, I am Roy Furr. I'm the Advisor CMO, and I'm back with another episode of the Daily Discovery Calls for Financial Advisors podcast. In this episode, we're going to be talking about money models for financial advisors, how this can be the secret to rapid scale. And we're going to go into the math behind this. Now, I will say, if you're a financial advisor, you're probably better at math, at actually doing the math than I am. I promise you that. However, I understand the thinking behind marketing math that drives success, that drives scale, and how this can be a massive advantage for anybody in any business. But today we're talking about we're talking about financial advisors, we're talking about RIAs, and we're going to talk about how your money model and the math behind it drives your ability to invest in marketing and to scale your business as a result. So in this episode, we're talking about strategic marketing math for growth-driven financial advisors. It's broken into 2 parts, really. Part 1 is going to be the money math principles that let businesses grow fast. So this is the rules behind the math. And part 2 is how money models could limit or unlock growth. We're going to look at specific calculations, illustrations of some financial examples, right, of what a client value looks like for a financial advisor in the short and long term, and how that is going to impact your ability to invest in marketing. So before we dive into either part 1 or part 2, I want to throw this out here as a disclaimer. I know, your client's financial well-being should come first. And it is really easy when you get into money models here. And we're going to talk about my inspiration for using this specific language for this episode with Alex Hormozi's recent $100 million money models launch. It's really important that your client's financial well-being should come first. And I don't want you to use this episode as justification for just exploiting clients. It's just not good business. It could get you in trouble in the long run. It's not good human being, right? It's not being a good human being. And so the point of this episode is not to tell you, you just need to extract maximum money in minimum time from all your clients. That's not really the point of the episode. But the point of the episode is that with the right money model, you can actually make a much bigger impact. You can make a positive impact on many more clients' lives. And when you understand that, if you apply that general principle to your to how you approach structuring the economics of client acquisition in your business, then what you'll find is that you are just able to grow your business in a way that is going to make that bigger impact. And what I'm doing with these concepts and illustrations is just challenging what I see as entrenched thinking in the financial advisor market. And, financial advisors are not alone in this. There's a lot of people who are essentially, they engage in the race to the bottom. If this person is offering something at 99 cents, I'm going to run a sale where it's 98 cents, and then they're going to run a sale where it's 97 cents. And it is this race to the bottom of trying to make things cheaper for the client, which in the short run does feel like an advantage to the client, that you are actually benefiting them. But in the long run, if your business is not profitable and you have to shut it down, there's no benefit to the client in that. And racing to the bottom will push you to that point. Now, you're probably not going out of business if you don't have the best money model, but you're not running the optimal business for you and for the total impact you could have in the world. So I want you, I may even talk about potential money models here that are not in alignment with what you are willing to do at your firm. And that is fine. You are going to make your own decisions about what's right for your firm. This episode is primarily just about thinking differently. So with that disclaimer, let's dive into part 1, why your marketing math is critical for rapid scale. So if you want to grow your business fast, if you want to grow your financial advisory quickly, that's going to involve getting a lot of new clients. And marketing math is like the secret engine behind that. One of the most famous copywriters of the 20th century, marketing thinkers of the 20th century, was Gary Halbert. And he lived into the 21st century, but certainly he was a giant as I was entering into marketing. And he said, marketing comes down to 2 things. It comes down to behavioral psychology and math. And most people don't want to think about the math. Behavioral psychology is just putting the right message in front of the right people at the right time, such that they say, oh, that's cool. I'm interested. Let me go pursue that, right? The math part is how much did it cost to put in front of them and how much is it going to make you back as a result of that person seeing it, right? And so the math part is what actually allows for putting out that message at scale. And my first point that I want to say about marketing math here is that financial advisors survive on marketing so bad that it would destroy most businesses. And what it comes down to is the big picture math of the financial advisory business. So I'm going to quote here from the Kitces Report 2024 marketing study. So it represents 2023. The report came out in 2024. Obviously, things have changed, but this is the most recent one. So in the Kitces Report marketing study, it said, as new client growth slowed and marketing costs rose, marketing efficiency fell by half. Efficiency for the typical practice measured in terms of the ratio of new client revenue over marketing costs fell to 0.6 in 2023. In other words, 60 cents in new revenue was generated from each $1 of marketing expense. So notably, this means the typical advisory firm spent $1 to acquire 60 cents of organic growth, a 1.67x multiple that is still substantively better than M&A multiples that are as high as 2x to 3x revenue for many advisory firms today. So it's saying for every dollar spent on marketing, the average financial advisory was only getting back 60 cents in revenue. And what that means is you're not breaking even until year 2. And with the 2x to 3x for M&A, what they're saying there is that you're breaking even in year 3 or maybe year 4-ish. So marketing is still a more effective way. Organic growth is still a more effective way to grow your practice in terms of the speed of return of capital. However, it's not great because you have to wait until the second year in order to be able to spend all of that money again on marketing again. And that's really the challenge that we're talking to here, is that when you have to wait for more than 12 months in order to make back your investment in marketing, it is really, really, really difficult to grow, right? So just quickly in reference to this Kitces Report quote here. So if you want to calculate your marketing efficiency ratio, what you do is you look at your new client 1-year value. So what if you look back over the past 12 months, or if you look back over a calendar year, what is the total revenue that all of your new clients generated? And then you divide that by your all-in marketing costs. Now, you can look at just hard costs and it's probably going to look a lot better. So there are a lot of financial advisory firms that spend almost nothing on marketing. So their marketing efficiency ratio may look great, but they're not calculating the soft costs of all the advisors going out and networking and all of their time spent going and chasing new business and trying to find new business and the cold calling that the advisors are doing, because that's marketing. It just shows up as a soft cost. It shows up as a human cost, a cost of labor. And so if you take the financial advisor's time, the value of their time, and you add that, or other members of your team who are doing that for the financial advisors or with the financial advisors, you add all the soft costs into the hard costs, your marketing efficiency ratio is probably going to look much, much worse versus just calculating the hard costs. So when you calculate the marketing efficiency ratio, take all of your first year client revenue and you divide that by the marketing expense. And that's how you figure out your marketing efficiency ratio. And it's really smart to do that, because that represents the effectiveness of your total marketing approach, how cost effective or not your total marketing approach is. Now, part of the reason that the financial advisory business is such a good business, and what allows financial advisors to survive on what, like I said here, marketing so bad it would destroy most businesses, is that financial advisors have lifetime value, client lifetime value on lock. This is what dictates the long-term profitability of your business. So if you're losing money in year one, but your stickiness is 15, 20 years or more in terms of clients staying with you, not only that, you're hopefully not losing their money. And so your annual value of that client sticking with you is increasing through time. The total value of acquiring a client allows you to just succeed on stupid first year marketing math, like really bad first year marketing math. And the truth is, this is where many businesses struggle. They may be able to get a customer and do very well with it in terms of the first transaction or the first couple transactions, but they don't understand lifetime value, and somebody doesn't necessarily stick around in the same way that they stick around in the financial advisory business. And so you're making so much money from each client every single year that it makes it easy to succeed. It makes it easy to succeed for the long run, because you're getting clients and you're just continuing to generate revenue for every client that you have in your universe, in your book of business. But what I call 1YV here, or first year value, is a massive limiter on your ability to scale. So how much you're making from each client in the first year that you do business with them is going to always limit your ability to invest in business growth, in business development. Or even better, look at 90-day value. And so if you are able to spend $1 and have it bring back more than $1 in the first 90 days, well, then that marketing budget, let's just say that for every $1 you spend on day 90, you have $1 back. Well, suddenly the same marketing budget can be rolled over 4 times. And so every 90 days, you're spending the same $1 on marketing. And so your marketing budget looks a lot bigger, but you're not really adding more to it, in the same way that you would have to if you're trying to spend that same amount, but you're not making back that in revenue until year 2. And this is what high growth businesses optimize for. And that's what this money models thing is about. It's that high growth businesses optimize for the initial revenue that is coming from the beginning of a relationship with a client. And so you grow fast by optimizing for initial revenue. You grow extremely profitable for the long run by optimizing for lifetime value of the client. And so we're going to be talking about both of those things here, but primarily today, we're talking about the initial revenue, because that initial revenue is what allows you to invest significantly in customer acquisition. In fact, the number one rule behind rapid scale, and if you've been around the marketing world at all, like in addition to the financial advisory business, you've probably heard this either quoted or you've heard it from who I think of as the source, which is Dan Kennedy, a sales and marketing expert. He says, whoever can afford to spend the most to acquire a client wins. Whoever can afford to spend the most to acquire a client wins. And so if you can afford to spend more than the financial advisor down the street to market to put yourself in front of, to sell to the same client, there is a high likelihood that that person is going to choose to do business with you over the financial advisor down the street. If they are more familiar, if they, as a result of your marketing investment, know, like, trust, and revere you more than that person down the street, then they are going to choose to do business with you, and they're not going to choose to do business with the person down the street. And that's often a result of more exposures. That's, for good or for bad, it doesn't matter the quality of the financial advice that you or the guy down the street are able to provide. That person is more likely to choose you if they are exposed to you more often, if they just have more time with you and with your marketing messages. Now, what's interesting here and what reinforces this idea is that advertising distribution has become a fairly efficient market. Meaning, your competition in the advertising marketplace is everyone bidding for the same person's attention. And so if you have, Sam and Pam down the street and they're on the verge of retirement, and they may be your ideal client for your financial advisory services. And so you, whether you are doing it consciously or just through how the algorithms work, if you are trying to get Sam and Pam's attention, if you are bidding for their attention in the advertising distribution marketplace, you are willing to spend a certain amount to get them to click on one of your ads. And so you're feeding that willingness to spend into the algorithm. And you're not just competing against every financial advisor. You're not competing against the people who would want to buy a 60-minute radio show on Sunday morning on a local radio station. You're competing against everybody, every advertiser in the world who also wants Sam and Pam's attention. And so it could be, maybe they're golfers. One or both of them are golfers. And so there are golf brands competing for their attention. Maybe they're concerned about health. Maybe they've recently had a health concern that shows up in their search history and shows up in their website or web browsing history that is driving different advertisers to be targeting them based on that particular medical condition. And so there is this efficient marketplace for attention, essentially, taking place online where a large volume of traffic is going. And because that marketplace is efficient, the price is going up to meet demand. There is effectively a limited supply of Sam and Pam's attention. And the cost is increasing to meet the demand for Sam and Pam's attention. And so all of that to say that is what's going on. That's the dynamics behind whoever can afford to spend the most to acquire a client wins. So when you're competing for Sam and Pam's attention, if you're willing to spend more than the medical clinic down the street and more than the golf brand that is selling them, whatever they're interested in for golf, and more than the car company that wants them to buy their next car from them, and more than all of those other advertisers, that's when you are able to get their attention. That's when you're able to pay to put your marketing, your advertising in front of them. And that is how you're able to scale, is winning that efficient marketplace auction. It's called an auction on a regular basis. So if you want to acquire clients fast, here I'm throwing a few lessons at you as part of this part one, why your marketing math is critical for rapid scale. So if you want to acquire clients fast, you would benefit from understanding this principle from another, actually, friend, colleague of mine, who has been very influential in marketing at large, not specifically financial advisors, and that's Perry Marshall. So in Perry Marshall's book, 80-20 Sales and Marketing, which has the foreword written by Richard Koch, who wrote the original 80-20 principle book, Perry talked about something called the power triangle or the tactical triangle. And By the way, this is one of those episodes that has a few visuals that I'm going to try and describe. But if you're listening to the podcast, you can check it out on YouTube if you want to see the visuals as well. So we have a triangle on the screen here, and it has a smaller triangle in one corner, in each corner. And in one corner is T, and one corner is C, and one corner is E. And that stands for traffic, conversion, and economics. And actually, there's some internet marketing history here that Ken McCarthy, who taught many of today's online marketing experts and was another client and friend of mine, Ken talked about success online is traffic and conversions. So it's not enough to just get traffic to your website. It's not enough to have just a high converting website. You need a lot of traffic to go to your website and convert in order to make sales, right? Well, what Perry added, actually what his marketing manager, Jack Bourne, added and then Perry popularized together with Jack, was this idea of it's not enough to just have traffic and conversions. It all has to be at favorable economics. And so your ability to buy traffic or to acquire traffic, you have to convert enough people for enough revenue. So you're optimizing for all three of these in order to make it successful. And it's a feedback loop, and the 80-20 principle applies. So, the top 20% of marketers in terms of the ability to generate traffic and generate conversions at favorable economics are going to get 80% of the market. And the top 20% of the top 20% are going to get, the math is like 56 or maybe it's 64% of the market. They're going to get 80% of the 80%. And so what happens is there is a highest performer that's going to get a very large proportion of the market just because they understand all three of these things. They need to know how to effectively get traffic, get eyeballs, get attention. They need to know how to convert that into being a client, into being, a customer. And they need to do that all at favorable economics, meaning the traffic is cheap enough, but the revenue is high enough so that they are able to continue to grow and to scale. Today's focus is economics. That's what we're talking about in today's episode. And I'm not just talking about the money that you get. I'm talking about the value that your clients get as well, because there is a feedback loop there in the economics. So if you optimize your business to just get maximum revenue by providing minimum value to clients, you're probably going to end up, maybe wearing stripes. But if you optimize your business to increase the value, to maximize the value your clients get, while also charging a fair price that is higher than your competitors, then that's really the secret to effective economics here. Providing so much value that your clients, that the right clients for this offer say, oh my God, this is worth paying more than everybody else for. This is worth paying a substantial amount of money to this person because the value that they provide is so far and away above anything else that I can get out in the marketplace. And that kind of thinking here should go a long way for you to support, oh yeah, I could probably charge more if I think about it in that way. If I think about, if I'm able to charge 3 times as much, 5 times as much as my competitor, or get that much in the first year, but I'm able to provide 10 times as much value, then it's going to be a no-brainer for clients who are able to afford it to come to me because I'm just providing so much more value and I'm able to show them that value in a way where it's easy for them to say, well, if I just go with the cheap option down the street, I'm not going to get the same fulfillment out of becoming a client of that person down the street. Complete sidebar here. Earlier this year, I bought a saddleback leather bag, and it's a laptop bag, right? It's a fancy laptop bag made out of leather that is probably a good 10 times as much if not more, 10, 15, maybe even 20 times as much in cost as I would spend on pretty much any other bag. I'm usually pretty much a cheapskate, but for saddleback leather, at least the perceived value of this bag, being built for life, which is a big promise that they've built into their brand. They'll fight over it when you're dead is their marketing slogan that basically says there's a 100-year guarantee on all of our products because we put that level of craftsmanship and care into this bag. Not only that, I like the aesthetic of the saddleback leather bag. I was willing to spend, easily 10 times more than I would otherwise spend for a laptop bag so that I could buy that saddleback leather bag. And that is what I'm talking about here, where the value that the person puts on the service justifies the higher price, and it changes their economics, right? Okay. Now let's get to the money models language. Now, I'll admit here that I'm piggybacking a little bit Alex Hormozi. I have gone through his $100 million offers and $100 million leads books multiple times. They've reinforced a lot of my pre-existing thinking. They've given me maybe better, simpler, clearer models for some of my other thinking. I really respect the value that Alex Hormozi packed into those books. This $100 million money models book, as soon as he said it was coming out, I said, I'm going to get the book. And then he started making this huge deal over the launch of this book, $100 million money models. And ultimately, the whole thing is, I believe, a great object lesson of the thinking inside the book. But you get 99% of the value by just watching what happened. So my understanding from the outside, I wasn't involved on Alex's team, so I can't confirm any of the numbers. But my understanding is that he drove about $100 million in total sales by doing this huge internet marketing launch with live streams and all of that, and affiliates and all of that, driving sales, not just of the book, but of this package that was like all of these different books that are supposed to reflect his thinking, that were, exclusive bonuses associated with the launch, alongside this package where you were gifting 100 copies of the book to other people. It's kind of a weird offer, but it was a way to pack perceived value into the offer. So you're gifting 100 copies of the book, or maybe it was 200 copies. When I saw all this happening, I kind of just sat back and said, I know that is not worth my time today, so I am not going to participate in this launch. But my understanding is that there was about $100 million in revenue associated with the launch of this $100 million money models book. He claims to have broken a Guinness Book of World Records record and sold 2.9 million books in a single day. And, really the lesson from that is, if you can turn your book launch into a $6,000 offer that sells 100 books at a time, well, then, which is a money model, then you can break some of these records and you can put up some really impressive numbers. Now, the question in the long run is, does the potential damage to his reputation from doing a hyped up launch like this, is it going to be worth it in the long run? And I don't know. I will say that I was ready to pre-order the audiobook on Audible, but it wasn't available until he actually had gone through this launch. And I have yet to actually just use that Audible credit on it. For, whatever reason, it just turned me off a little bit. But I will say that one thing that he really does nail here is this idea of a money model, and the simple language around money model, and saying, this is a model designed to identify revenue opportunities within a business, potential revenue growth within a business. And one of the fundamental approaches that Alex has taught from early on in his different books was that if you can move revenue forward towards the acquisition date in a business, it allows you to invest a lot more in marketing. He's also a student of Dan Kennedy, the whoever can spend the most to acquire a customer wins, that being able to move as much revenue as possible forward within the business, as well as to establish different money models that maximize client lifetime value, that it does allow you to build and scale a business that becomes much bigger, much faster than if you are not applying these principles. And so I'm not saying you should copy Alex Hormozi. Again, I got a little bit of an ick feeling from this launch. So whether you liked it or not, that's not the point here. The point is that I'm using it, I guess, as partially as inspiration to share some of my experience and thinking around money models for financial advisors, and really tell you why some of the fastest growing advisories are able to grow so much faster than many of their peers in the business. And so with that, that's the conclusion of part one, why your marketing math is critical for rapid scale. That if you figure out an effective money model for maximizing revenue initially within the business, and you're able to spend that on marketing for your business, on business development, on acquiring new clients, then you're going to have an advantage stepping into the marketplace. And, with that as the fundamental principles, we're going to come back to that. We're going to just layer more thinking and more specifics onto that here by talking about money models for financial advisors, which is part two of this episode here. And by the way, I say it's part one and part two. I'm not splitting it into multiple episodes. It's just the first half and the second half. So I will say that in talking about these money models for financial advisors, I'm doing something that's maybe akin to killing sacred cows here. You may hate some of what I say in the next few minutes. Especially if you're very focused on, we run, let's call it the Boglehead principles, right? That we are focused on driving down the fees, driving down the cost for our clients as low as possible in order to have them be as financially successful as possible. I'll say that I applaud that from the client side. I will say that I am, even as I work with financial advisors, I'm in the accumulation phase of my life right now. And I prefer, low cost, diversified portfolio, primarily of funds that keeps the cost down as low as possible in order to accumulate as much as possible for the long run. And, I'm not going to knock Vanguard. I'm not going to knock Jack Bogle. I'm not going to knock any of that in terms of the value that it does provide to clients. What I will say is that a lot of the money models that allow financial advisors in particular to scale are maybe the best fit for advisors who focus their business instead on people who are in the transition from the accumulation phase to the distribution phase, and in the transition from their working life to their retirement, where there's a lot higher management and planning that are required. Management, not just management of the portfolio, but management of the total financial plan. And what is appropriate for the accumulation phase, when all you're trying to do is have a very simple, diversified portfolio, ideally that will minimize cost and maximize growth, that's very, very, very different than this phase where there is things like tax planning, where there's income planning, where there is mitigation of different life risks as well as financial risks, where there may be some legacy planning, estate planning, that sort of thing, where there's a lot more active management of the total financial picture. And when somebody enters into that phase of their life, it's probably going to make sense for them to invest more in a professional who is able to handle all of those things and not just keep them in a low-cost portfolio, right? So you may hate some of what I have to say here, but I'm going to tell you why commissioned non-fiduciary financial advisors, I'm going to show you the math on why commissioned non-fiduciary financial advisors can outmarket, and that's primarily defined by outspending the good guys. And I'm going to call out the race to the bottom in terms of fees. I mean, if you're competing for the lowest fee, you're competing with Vanguard, who has just massive assets under management. And it's going to be hard for you to compete there, right? It's hard to out Walmart, Amazon out Walmarted Walmart. But it's now hard to out Amazon. There is a race to the bottom that often comes with scale if you are trying to be the lowest cost. And going back to the discussion of the power triangle, Perry Marshall, for economics, if you stack the value, you can justify a higher expense, a higher amount of revenue, a higher fee that you are charging them by providing more value. And you are likely to be able to grow your firm much faster by finding the people who want that higher value and giving it to them for a slightly higher cost. So let's go into my demonstration, my calculation of the money models. Just quick explanation here before I actually show you the math. And again, if you are listening to this episode, there are some visuals here. I will try to walk through them as clearly as possible, but you can see the visuals by popping onto the YouTube channel for TheAdvisorCMO. Okay, so we're going to be talking about a $500,000 client. I'm doing very simplified illustration. So for example, when I calculate the 10-year value of this client, it is based on just having them continue to be a $500,000 client. I'm not doing any complex modeling there. A lot of the point of this is just to show you the value, some initial value that the different models would provide, initial revenue that the models would create, and then have that give context to some of what I'm talking about here with your ability to spend on marketing. So for this $500,000 client, I'm looking at 5 different scenarios. The first is 100% AUM at a 1% of AUM fee that's charged quarterly throughout the year. The second scenario is 100% AUM. So you're only getting money based on assets under management, right? You're only generating revenue based on assets under management. 100% AUM at 1% with an initial planning fee. So you're charging a planning fee, and then they're paying based on AUM for your ongoing portfolio management and ongoing financial advice. So the initial planning fee, to recognize that the beginning of a client relationship is the highest workload, right? Is that onboarding of the client and doing the planning and implementing the plan, having a fee for that on top of the 1%. Then we're going to talk about what I think, some advisors would just shut me down for, which is splitting some of this between AUM and annuities. And actually, I didn't put it in my notes here if you're looking at the screen, but this is based on a 1% of AUM and 6% of annuities commission. Now, the 1% of AUM is recurring. The 6% is all upfront. So looking at a 60-40 split on that and looking at a 40-60 split. So on one side is 60% of client assets going to AUM, 40% going to annuities, and then vice versa, flipping that around. And then also looking at flat fee only, which is the advisors who say, I'm not going to charge you based on the assets that you have because it's not going to take me more time. I'm just going to charge you a fee for that service. Now, the big difference here when we look at the models between the initial planning fee and the flat fee only is I assume an annual repetition of that flat fee only versus the initial planning fee being just a one-time fee. So that's the 5 scenarios. The math here, and I will zoom in because I took a screenshot of the spreadsheet. So you can look at the math. I'm going to focus on what I consider to be the most important here. So in the first scenario, where 100% of that $500,000 goes to assets under management, and that generates a 1% fee, there is a 1-year value, first year value of $5,000, right? There's $0 in annuities, 0% there, 0 first year value from annuities, and 0 planning fee. So that means that the first year value for that client is $5,000. And if you want a marketing efficiency ratio of 1 or higher, you have to be able to acquire that client for $5,000 or less. Now, I did an extra calculation here, looking at just the first quarter, looking at just the first 90 days, because I'm assuming that you're actually getting paid quarterly on that. And so the 90-day value of that client is $1,250, which means if you spent $5,000 to get a client, you're still $3,750 in the hole on that client, and that money is not coming back. Now, the 10-year value of that client, assuming retention for 10 years and assuming everything else stays the same, again, simplified illustration, the 10-year value of that client is $50,000. And so, the 10-year value is very high of that client, and that's great. But in that first 90 days, which is going to be a large part of what you're able to use to justify your marketing spend, you're only getting $1,250 back. Now, if we match everything about that scenario, but add an initial planning fee of $3,500, your 1-year value is $8,500 and your 90-day value is $4,750. So if you spend $5,000 to get that client, you're almost breaking even within 90 days. Between the first quarter of the AUM and the planning fee, you are almost breaking even. And your 1-year value, you're already ahead in your first year. And the 10-year value is almost identical, but we just added the initial planning fee on top of it. So the 10-year value is $53,500. Now, here's what you are not going to like if you insist on not selling annuities. Now, I'm not going to get into the goods and bads of annuities too much, besides to say that I'm not completely against annuities. I am, I'm not a fan of like IUL policies, but annuities for the right person that are able to guarantee that lifetime stream of income have been shown through research that they make someone more comfortable with spending money in retirement. And oftentimes they're able to invest in a better lifestyle for themselves because they have converted at least some of their savings into a lifetime income stream. And so just in terms of the lifestyle that someone enjoys, you're not going to be able to convince me that refusing to sell annuities is necessarily the best thing for them. Now, you can argue that getting 6% on annuities versus 1% on AUM may motivate someone to push someone into annuities when they don't necessarily need that product. You can argue that all day long. But just in terms of client well-being, there's not necessarily a open and shut case against annuities here. So doing the math on a 60% AUM and 40% annuities split, that means $300,000 is going into AUM, and that's generating $3,000 in the first year, and $200,000 is going into annuities, and that's generating a $12,000 commission basically as soon as the sale closes. Now, this is where things change quite significantly when it comes to marketing math. So that means the first year value of this client, based on this 60-40 split of $500,000 in assets, is $15,000 versus, the highest, having the combined fee plus AUM, was $8,500. And so you've basically doubled the first year value of that client. Not only that, you have basically quadrupled the 90-day value of that client, because you're getting the $12,000 commission on the annuity right away, and you're getting $750 on the AUM. So your ability to spend on acquiring that client has just almost quadrupled by, within the first 90 days, getting all of that money for the annuities, as well as a very small amount for the AUM. And so what this means is somebody who has annuities as a fundamental part of their client services portfolio of what they're able to offer is able to significantly outspend somebody who only does AUM. Now, in the long run, that annuities client is worth a little bit less, because typically that annuities commission is a one-time commission, right? And so you get $12,000 up front, but nothing in the future, versus year after year after year, within 7 years, the AUM generates more revenue, and the 10-year value is $42,000 on that versus $50,000 for just 100% in AUM with no planning fee. So if we go even heavier into annuities, if we go 40-60 split, so annuities are 60%, AUM is 40%, then the AUM is generating $2,000. It's $200,000 generating $2,000 in commission the first year. The annuities are $300,000 generating $18,000 in commission the first year, which means in the first year, that client is worth $20,000 to the firm that is selling 60% annuities, 40% AUM. And the 90-day value is $18,500. So again, we have well over tripled the 90-day value, even versus the person who does the planning fee versus the 1% of AUM. The 10-year value has continued to go down because we're assuming it's just 6% commission and no future commissions. It's $38,000 versus, $50,000 or $53,000 for the folks who don't do annuities at all. But they have more than triple the marketing budget in the first 90 days. Not saying that they would spend that, but if you're able to spend $6,000 when someone else is only able to spend $4,000, that puts you at a significant advantage. Not only that, you're profitable significantly within the first 90 days. You've tripled your money in the first 90 days. And then, perhaps you could spend $6,000 in 3 separate places where the other person is limited to $4,000 in one place. So the marketing budget is just so much bigger when you look at this math. We're one final comparison here, and arguably this is almost the worst of the bunch, is the flat fee only advisor, where we're assuming the same planning fee, $3,500, and the first year value of that is $3,500, which is the smallest. The 90-day value is only the second smallest. The lowest 90-day value is the person that is just flat AUM 1% and getting paid quarterly on that. So the 90-day value, heck, if you're paying monthly, it's getting paid monthly, it's the same. But the 90-day value here is that $3,500 planning fee. The 10-year value is also the lowest of the bunch at $35,000. If we multiply that out over 10 years and assume 100% retention of this client and assume that no fees change. Again, simplified illustrations for the sake of not making this absolutely crazy. But what you're seeing here is that your choice we're only going to do that AUM commissions of we're going to do fee only, but it's a percentage of AUM, versus we're going to do fee only, but it is a percentage of AUM plus a planning fee for new clients, versus we're going to do flat fee only, where you don't pay based on your percentage based on a percentage of your assets, versus we have some mix of annuities and AUM where you're paying a fee for the AUM, but we get a commission on the annuities. All of this, I will say, should be transparent to the client. And so, in fact, legally, it needs to be transparent to the client. We get a 6% commission on this annuity. We are still choosing it for you. Yes, it does benefit us more in the short term. It may not benefit us more in the long term, but it benefits us more in the short term. We're still choosing it for you because we consider it to be the best option for you for today. But it does change the marketing math significantly. And so when you are in a marketplace, even if we didn't look at the total auction, the total efficient market of advertising across all potential people bidding for the attention of the same person, and if we only limit it to people who are offering some kind of financial services, the people who are offering annuities and getting paid this commission for selling the annuities are able to spend more to acquire a client in order to grow their firm. And it puts them at a significant advantage here. Now, again, you have to choose the best thing for you, but I want to look a little bit more at the marketing budget impact. The first point I want to make here is that 90-day value. That 90-day value plays a big role in how much money you're able to spend on marketing this year, because if you get 100% of your marketing dollars back every 90 days, that's going to essentially allow you to spend the same dollar 4 times in a year. It's going to allow you to quadruple your marketing budget for the year. Again, these are all hypotheticals, right? But I'm saying in this illustration, if you get that same dollar back in 90 days, you can spend that same dollar the next quarter and the next quarter and the next quarter. And it creates this recycling effect of your marketing budget that makes it go 4 times as far. And so there is a significant advantage to setting up your business in a way where the money model supports the ability to spend the same dollar more frequently in marketing. And it just gives you an advantage that's hard to beat. Now, another concept from Perry Marshall's 80-20 sales and marketing is this idea of winner takes all. And so if you're able to spend more than your clients or than your competitors to acquire the same client, what's going to happen is you're able to show up in that top search result. You're able to show up more often in retargeting, remarketing. You're able to show up in Meta more frequently on Instagram, on Facebook. You're able to maybe put ads on TV in places that are not as affordable for them because it's offset by that person who saw you on TV also seeing your ads online. You're able to just spend more in more places in order. I've talked about Google's 7-11-4 rule, where somebody needs 7 hours of engagement across 11 separate touch points in 4 separate media channels in order to move into the active buying process. Well, you're able to spend more to show up in more ways and more places for them in that regard, which makes it more of a winner takes all marketing. It's a flywheel effect. It's a snowball effect that the more you're able to spend on marketing, the more effective and efficient that marketing spend becomes, because all of it is contributing to a more effective total client acquisition system or a more effective marketing program. And that is also why marketing efficiency ratio is so important to look at as a number instead of just the return on ad spend from a specific media channel. That when you have all of these things working together, the whole is greater than the sum of the parts. And so all of this to say that the better your economics are working, the more effective it can make your marketing budget. I have another note here that the top link gets the highest click-through rate, and that's just consistently true. If you're showing up first, if you're showing up higher on the page, if you're able to pay for those premium positions, you're going to get premium results. But it only works when you have this whole idea of like traffic conversion economics all working in your favor. And so just to kind of put a bow on all of this, I have a few reflections here on the money models that I've talked about. The first is that it might be outside of your business model. going to selling annuities and getting paid a commission based on annuities. If that's outside of your business model, that's okay. Like, I'm not telling you you have to do that. What I'm saying is that the people who do that are at a financial advantage in the marketing marketplace, the advertising marketplace, competing against you. I will say that even fiduciary financial advisors can charge a planning fee, and that's going to allow you to be able to scale quicker. There are also lots more variations possible. So, for example, tiered AUM, where the first couple 100,000 is at a higher percentage, just to give you more revenue upfront and allow you to pursue a broader marketplace. And then, as somebody gets up into higher net worth, your percentage fee drops down significantly. You understand that, as well as I do, probably better. But with this, what I want to say is that I simplified these models just to make the point, just to share these principles, and to help you understand how all of this does have an impact on your marketing. So the most important thing that you need to understand is the impact of this math on your marketing, not just how much of a budget you have for marketing this year, but how effective your marketing budget can be in a competitive marketplace where there are people out there who are willing to spend more, who are able to spend more to acquire a client than you're able to do. So is your ability to spend on marketing putting a ceiling on your growth? That's the most important question to ask yourself, right? Is your ability to spend on marketing putting a ceiling on your growth? If you were able to spend more per client and have that come back quicker to acquire that client, would that allow you to grow, to scale faster? And then what do you need to do to provide the value that justifies maybe somebody paying a fee up front, paying a planning fee up front? How can you build your firm around that increases the perceived value, the actual value that they get out of your services, such that it justifies maybe that upfront planning fee, and you're able to invest more of that back in marketing? And I have a note here, optimizing for price versus value and justifying higher prices. That's exactly what I'm saying here. Don't just optimize to be able to get the most money out of them, optimize to be able to deliver as much value upfront as possible. And it doesn't always just mean more. Oftentimes it can be focusing on that one thing that is the biggest value lever that you can pull, that's going to make the biggest difference for them. It's going to be a demonstrable value where they're able to see, okay, this person is generating a ton of value for me. To be specific, oftentimes this is things like tax planning. If you look at their lifetime tax obligation based on qualified accounts, based on what's in their IRA, their 401k, and you're able to say, if we do these strategies, here's the impact that it could have. And then you're not even talking about the value of, like, we can manage your money and we can get you investment returns that, God forbid, you're actually promising that you're going to beat the market or anything like that. But you're able to look at the actual tax implications of their money being in tax-deferred accounts versus moving them towards tax-free accounts. And even that tax planning can be a strong way to justify maybe that upfront value. One more recommendation here, just in terms of scaling. In the average financial advisory business, the hard costs of marketing are often down in the 1 and 2% range, 1 or 2% of revenue. And it's no wonder that companies like that aren't bringing in clients at any kind of rapid clip. In businesses that are growing somewhat, they're often spending 10% on marketing, on advertising, on putting their message out into the world. On businesses that are growing at a really rapid clip, that can be closer to 20% or more. Some of the businesses that I've worked with just invest in marketing as fast as they can invest in marketing in order to build the total enterprise value of the company, build the client base, the customer base. And so what I have here is the 15% rule. If you want to be a rapid growth financial advisor, you should probably plan on spending at least 15% of your revenue to acquire new clients, because bringing that new blood in the door, bringing the new clients in the door is what's going to fuel your growth for the long run. And it's going to be all the easier if you take the fundamental lessons, the principles from everything we've been talking about in this episode, all the marketing math, all the money models, and you apply it so that you don't have to spend 15% of your revenue at a, below 1 marketing efficiency ratio, that you're able to have your MER, your MER, above 1. And so you're making that money back as fast as you're spending it. All right. So wrapping up, don't forget to subscribe. If you want more content like this, if you found this valuable, also feel free to share it with a friend. That's how this is going to grow. It's how I'm going to be able to provide more value to you. You can find me on LinkedIn. I'm Roy Furr, ROYFURR, or you can search for The Advisor CMO. And I do have some free training. It's a 12-minute video on how to create discovery call offers that make your ideal clients actually want to speak with you. And you can find that at TheAdvisorCMO.com/discovery. Again, if you want to position your discovery call in a way where your ideal clients are actually coming to you and saying, I want to have that conversation, that's at TheAdvisorCMO.com/discovery. And with that, I will see you again in the next episode. Thanks for tuning into this episode of Daily Discovery Calls for Financial Advisors. If you got value from this episode, I'd absolutely love it if you do me the favor of sharing it with one other person who you think would also find it valuable. It's how the show can grow and how I can keep bringing this value to you. And if you want to learn more about how you can book more discovery calls with your ideal clients, go to TheAdvisorCMO.com/podcast.